Well, welcome to people joining us for this quarterly review, February 2026. A bit like last time, lots of things have happened in the last 90 days, so the changes this quarter have been quite profound in many ways. Some of them, strategic or perhaps structural, but it's something that only time will tell. So we'll go sort of look at some of the stats that have come out. Let's look at how they're going to impact not just the Australian economy, but obviously the Australian property markets around the country, and how those impact our clients and investors and people looking to enter into the property market perhaps for the first time in 2026, or looking to add to their existing property portfolios. So here's a disclaimer. All of this is general information and not intended to be relevant to someone's personal circumstances, because we don't actually know those. So if you do need some assistance with your own personal circumstances, don't hesitate to reach out, and I hope you enjoy the information we're going to present to you. Now, it's interesting because last time, 3 months ago, we were talking about the RBA reducing interest rates further, potentially having another cut on Melbourne Cup Day, first Tuesday in November, and as we know, that didn't happen. And since then, there have been, a release of different data points, which has made the RBA look at not only not decreasing rates, but they've actually increased them. So let's have a look at also the impacts that has. People have asked questions about this, which is not unsurprising, and we'll delve into it with a bit more granularity. For anyone watching who doesn't know us, we have different businesses, discrete businesses, and they look after different sets of clients, but also many of our clients utilize services from all of those entities. Wise Guru is the international consulting business that has been specifically developed to help Australian expats living and working around the globe, and foreign individuals looking at buying property in Australia. So we're there to help people with all of the relevant challenges that they face in relation to acquiring property in Australia. And it's a little bit more difficult than if you're an Australian citizen, resident living in Australia, and lots of little nuances that go into that. Unicorp Partners is the licensed financial advisory firm that assists people with all of those matters: superannuation, risk management, investments that are mark to market, such as equities, bonds, etc. Aussie Loan Guru, as the name suggests, is a specialised lending business that assists people with procuring perhaps niche loans at times. So for Australian expat viewers, it's more difficult for them to get loans from the Australian banks than people living in Australia. And we have special liaisons and situations with various banks where we can give our clients up to 85% LVR or loan to value ratio without having them pay lender's mortgage insurance to the bank. So it's a great saving, can be tens of thousands of dollars depending on what property someone's looking to buy. And Aussie Property Guru is the licensed Australian real estate business. So all of those obviously can overlap and intertwine, but there's just a little bit of background. Now, our clients are, if you like, a certain demographic, but they're all high income earners, whether they live in Australia or they're living and working overseas. So whether you're a banker in Hong Kong or Singapore or specialist surgeon in Sydney, they're high income earners, but they're also very time poor. A lot of those people want to buy property in Australia to add to their existing asset portfolios and grow their wealth. And they want to do that in a well-informed and researched manner so that they can make some well-informed choices. The biggest thing, obviously, with this type of income earner is that they're generally very time poor, and I'm sure everyone knows what that's like. So it's very difficult to go and do all the research yourself and try and remove the noise from the signal, as it were, and that's what we're here to do, to assist people try and tie all that together. So we have our concierge service, which we developed many years ago, and that helps people with all of those things, because most of our clients, due to the fact that they are time poor, would like to have everything done for them. And we try and do that as much as possible. Clearly, the no-touch scenario is highly unlikely, but we try and make it low-touch for people to make sure they actually can get a smooth transaction happening without having to waste a lot of anxiety and time on it themselves. Now, the most common questions we've been getting asked. Well, it's interesting. They're sort of, I guess, divided up between, what's the Reserve Bank of Australia going to do? Are they going to keep raising rates after this first increase last month? Are they going to leave them on hold? Should we fix our interest rates because, rates are going up? Should we remain on variable? And then the other side is, because this time of year is well known for it, but usually you get, the newspapers and news media coming out with all of the suggested proposed changes to tax, and it's usually around negative gearing, capital gains tax, taxing trusts as companies, all the usual suspects, I should say. So a lot of it's been around that, but of course people are still saying, will property prices still increase now that rates have gone up, and we think they may go up further? And will rents continue to go up? Because rents have also been pretty strong, and we'll go and delve into some of that data in this presentation. And which areas are going to benefit most from, macro tailwinds, as opposed to generically what's going to happen right across the country, because people aren't buying an amalgam of an Australia-wide situation or market index. They're buying discrete individual properties. So let's have a look at some of that, because, the landscape has shifted significantly in the last quarter, as I said, and a lot of that due to, what the Reserve Bank has done in terms of raising rates at their last meeting, and then trying to understand why Australian residential property prices in most markets are continuing to increase, even though rates have increased now, but were stable for that last 90-day period. And then we have to try and remove, as I say, a lot of this policy noise, which is seasonal, always comes prior to the May budget. A lot of it's speculative, and look at what's actually going to happen. So, we've seen this. Anyone can go back and Google things and say, take the period between February and May of any given year, and there's always a speculation that the government is going to change negative gearing, change capital gains tax discounts, as I say, tax trusts as companies, and a lot of other, I suppose, somewhat negative changes to tax law, which have only really happened twice in history for a very short period of time. So I think it's far better to try and wait it out, wait till after the budget, and look at what's actually going to happen before you start making any plans, having any knee-jerk reactions about this, or even bothering to think about it too much, to be honest. But, pardon me, we'll wait and see. There's lots of discussion currently about, reducing the capital gains tax discount upon sale. If the government ever does do anything on this, then I think it will probably certainly not be a retrospective situation. There's got to be a whole lot more discussion go into this, because even Bill Kelty, ex-Australian Union heavyweight and supporter of the Labor Party, has said that simply reducing the capital gains tax discount without other more major tax reforms, such as reducing the top marginal income tax rate from 45% to 39%, I think was his suggestion, is not going to work. So I'd say just watch that space. But as we've often pointed out, research is really important, and Australia is such a large country, it's a big continent, that we've got to make sure that we get things right in terms of, looking at a location that we want to invest in, unless it's somewhere we have to buy to live. And putting all the data together is time consuming and difficult. So we use a lot of, ABS data, Department of Population Growth, the usual sort of research houses that give us data on a national basis. Cotality is one of the best, but there are numerous others. And we try and then overlay those data points with our experience and see if we can come up with a logical outcome. So, interest rates, very pertinent question at the moment. Where are they going to go? And we've got January CPI coming out tomorrow that might show us a bit more clarity. Data points have been fairly robust. So, a lot of commentators, economists have said that's forced the RBA's hand to raise rates by 25 basis points in February. And then, there's the usual slew of predictions about what's going to happen with rates going forward. I think there's a reasonable chance that rates may remain on hold for the remainder of 2026. A lot of economists think there's going to be another rate rise potentially in May. And I think that's, probably a 50-50 situation at this point in time. And well, let's see what the data looks like that's going to come in. That's obviously going to impact the way the RBA board react to things. They're trying to be, very conservative and protect, I guess, their reputation. Although that's a pretty difficult thing to do. And unfortunately, these days in many fields, people are really more concerned about, liability issues. Covering their backsides, as they say, rather than trying to perhaps get things 100% right. We'll see what the RBA does, but I think, for now, the base case scenario is to say, well, rates are going to remain the same or perhaps increase sometime during the year by a further 25 basis points. So during Feb, up until this review, as most of our viewers who have a loan know, rates have edged up. All the banks have passed on that 25 basis point increase the RBA brought down earlier this month, and I'm sure that if we get another one, they'll be keen to do that. But a 25 basis point increase in its own right is not going to have a massive difference, and people need to focus on that because it's not going to make anyone charge out and sell something. Or buy something. But, people are asking the question about should we fix rates? What should we do? And no one has a crystal ball, and that's a difficult question to answer. But I think at the moment, staying on a variable rate may potentially be more fruitful than fixing, but we can't tell till later in the year because most of the banks have moved their fixed rates up over the course of the last, number of weeks in the event. So these are the latest forecasts from Westpac, and if you have a look, the cash rate has increased to 3.85. They're predicting that we'll get another increase of 25 basis points in the June quarter. I still think there's a 50-50 chance that the RBA may stay on hold. Tomorrow's CPI data will be perhaps telling in what that outcome may be, but let's wait and see what happens with that, and we'll certainly put out a post in relation to that on LinkedIn and on our YouTube channel to let people know our thinking. If you look at the exchange rate, and that's something I'll come to as well, that really has been interesting and really important for both our Australian resident clients because as the Australian dollar has strengthened quite strongly over the last 90 days, that is going to play an impact on inflation, and it's going to be a factor reducing inflation in Australia. So imported goods will become cheaper, and since there has been strength in the consumer spending, that's going to assist. But the other thing, of course, is that our offshore expat clients who are living around the world earning money in different currencies, are going to get that same effect in reverse because their US dollars or Singapore dollars or Hong Kong dollars or pound sterling are going to be slightly less valuable if you bring it back to Australia. And a lot of our clients took the opportunity over the last 6 months to repatriate funds and I think get some very attractive entry points into the Aussie dollar. So we look at clearly finance with banks and finance data, and it's an interesting thing. The value of investor lending is up nearly 18% over the course of the year. And I think some of that is being masked by first home owners, the first home buyers saying, I can't afford to buy a place that I want to live in, let's say in Sydney in particular. But we want to live somewhere, they're going to rent, and they're buying an investment property in a location where they can actually afford to buy, whether that's in another Australian capital city, which may be a smaller one or a larger one, doesn't matter, like Melbourne, because the prices have gone down obviously far more than other capital cities there, or in regional areas. So they're going to rent where they're living but still invest. We've seen that, so I think that accounts for some of that increase. And the other factor, of course, is that people at the moment are seeing that return to thinking about property being a growth investment, like shares, but they're probably feeling a bit more comfortable with the stability of property investments over equity-based investments, which have seen quite a lot of volatility, especially in the last quarter. So let's look at one of the macro tailwinds that really need to persist to keep property prices firm or increasing, and that's population growth. If you have a look at what's happened to Australia's population, this is the latest data to June, net overseas migration continuing to be very, very strong at one of the highest levels that it has been since we started recording this, and that obviously has slowed down significantly. However, it's still very strong, and that's why you see, again, a lot of this coming up in the news where, people are saying we need to slow immigration so that people can afford to buy housing. I'm not sure that's actually a verifiable argument to have, because, one of the issues we have in Australia, of course, is we don't have enough skilled labour to assist with both the production of new homes and increases in terms of productivity for the economy in general. So, one nation perhaps might look at that as being a great political platform to run with, but I think from a real viewpoint, immigration is not the culprit. I mean, Australia has faced a shortfall of housing for decades, and it's simply not being driven as proper policy by the government to produce more housing or to assist the private sector to be able to fill that void. These projections still hold true going out. The ABS did this several years ago, out to 2034, and the states that are in the strongest positions there currently, Queensland, WA and Victoria coming in, but that's likely to continue. And if we look at the quality of credit that's being provided, so you've got people coming in, don't forget a lot of the net overseas migration, a lot of those people are going to rent somewhere, not buy, so pretty important. And then let's look at this, investor lending's up 17.7%, but let's have a look at what I suppose the regulators look at in terms of, as they say, credit risk. So, there's been new credit tightening, macroprudential policies setting into effect to pose 20% limit on high debt to income lending for new loan originations. And, several other factors that really are making the banks, if you like, pull back on interest-only lending as well, now being capped and so forth. But if you have a look at this, on the right-hand side, the percentage of loans originated with an LVR above 90%, that's remained really constant for investors and declining for owner-occupiers. Loans originated with a debt-to-income ratio of greater than 6 times, again, massive decline over the period and fairly stable. Loans originated with a loan-to-income ratio of greater than 6 times, very stable and low, and percentage of interest-only loans have increased. And the reason for that is, and I don't think that makes them risky, it's just that as rates have gone up, people are trying to manage their cash flows, and so they're seeking interest-only loans instead of principal and interest to bring their actual monthly repayments down. Makes complete sense. So let's look at property as an asset class, and we tend to do that for many of our clients. It's a pretty massive asset class now, $12.4 trillion worth in Australia, by far the largest asset class. And as I've often said in the past, people talk about the high level of indebtedness in Australia and other developed nations. But if you have a look, the amount of debt outstanding against that 12.4 trillion is actually only 2.5 trillion. So the level of indebtedness is extremely low. And that's something that people fail to realise, because most people are looking to purchase a property that are younger, certainly, are going to require a loan. And so they assume that everyone else requires a loan, and they're trying to maximise that loan, and they're saying, how do people afford this? Well, as those numbers show you, a lot of them afford it because they own those properties without any debt. And many of those people, especially the baby boomer cohort who are selling their homes now that they may have owned for 30 or 40 years, have got ample cash to buy new properties that suit their lifestyle without a loan, and have money left over to invest. So if we look at what's happened to property and housing prices over the last 12 months, have increased overall on a nationwide basis by 9.4%. But of course, as I keep saying, there are so many property markets within Australia and sub-markets within those. You really have to look at what's happening. But if we take that number, 9.4% for a year and 2.4% in the last 3 months. So pretty strong quarter. Total return for housing, 13.3%. I think anyone who's an investor would think that's pretty robust. They'd be pretty happy with that. So that's just combining, obviously, rental income and capital growth. And total return, for the ASX, the S&P 200, was 7.4%. And as I say, that's probably less as we speak today, because there's been a lot of volatility in equity markets, and that's causing a little bit of angst to some people, especially the ones that have just entered retirement or it's coming up. So that's something they need to manage in different ways depending on their personal circumstances. If we have a look at the 3 months change, because it's a quarterly review, and if we look at what's happened to those dwelling values, as we can see, there's quite a bit of change. Regional values have gone up more than capital city markets, 3.2% versus 2.1%. But then if we look at capital city markets, look at Melbourne, it's 0.1% increase, Sydney 0.2%, and then you look at, say, Perth at 7%, or Brisbane at 5.1%. Massive changes between the rate of growth in all of these various markets, and underpins the need for people to do that research. And then if we look at what's happened in the last 3 months to January, all the major capitals except Sydney and Melbourne have shown positive outcomes, and you've seen there, it's really the upper quartile in both Sydney and Melbourne that's had a negative, albeit not a large one. But then if you look at the smaller capitals, Brisbane, Adelaide, Perth, Darwin, they've all had pretty strong growth, and those numbers look to be continuing currently. Now this is the big one, it's supply and demand. That's really what's underpinning housing prices and continuing to, I think, make those strengthen, and that will continue whether rates, raised by 25 basis points or more or not. So if you have a look at that, medium density or high density housing, so apartments, generally far more volatile than freestanding dwellings. But if you look at that, dwelling approvals were significantly lower in December, and it's a volatile trend. But as you can see, the unit markets, number of units approved fell by nearly 32%, and that followed a 32% uptick in November. So you can see that volatility. But bottom line is, we're way behind where we need to be in terms of providing new housing in Australia, nowhere near the government's 5-year supply plan, and that's not going to change anytime soon. This is still a question we're getting, and more so, I guess, the last month or two. Should we be investing in shares, or should we be investing in property? And I wish it were that easy, but I think people need to try and invest in both. And I think they used to sit back and have a look and say, well, if I'm going to use leverage, then perhaps housing provides me a much smoother and safer option than entering into a mark-to-market margin loan to go and buy equities or any other market-linked investment. But, perhaps I can use my superannuation funds perhaps to do that and pick up the tax advantages of franking credits and the dividends that we get from certain equities. So there's quite a lot to it, and as we can see, both in Australia, both equities and property have performed very well. It's just that the volatility of one is far greater than the other, and I think that's the thing that people get frightened about when volatility starts to enter markets. So the other side of that coin is, of course, the rental market. How much rental income am I getting if I'm going to borrow to invest in a real estate asset? I'm going to have to pay interest, so what's the rent going to be like? And is that also going to increase as interest rates go up? Well, I think the answer to that is probably yes in most markets, because we're suffering a chronic undersupply. The rental market is super tight. Vacancy rates in many highly desirable markets is 1% or less, and rental rates are growing. So there are two distinct demographics here that are asking this question. It's the same question, but one cohort are the owners, people that own the properties, and the other cohort are the people that are trying to rent, the renting population out there. So clearly different outcomes for the two cohorts. Yes, I think rents will continue to rise, and we'll show you the numbers that are happening there, which is beneficial for the people owning the properties, but it's not for the people who are trying to rent them. And I think that's one of the reasons we're seeing this uptick in people who are rent investors, who are buying the property and might want to live in within 3 or 4 k's, let's say, the Sydney CBD. They can't afford to buy that, but they can afford to rent it, and they're going to buy something somewhere else, so they still at least are in the market in that asset class. So let's look at this. And since the middle of last year, actually, rental growth has been re-accelerating. There was quite a long period there where it was sort of stagnating, and now it's starting to increase once again, and fairly markedly. And the cost of renting has risen at 2.5 times the rate of wages increases over the past 5 years. So that's pretty significant, and that's another one of these cost of living pressures and issues that many people, especially younger people, are facing as they're devoting more of their personal exertion income towards shelter, somewhere to live. And that's what's caused people, I suppose, to share rental properties to try and amortise that cost over more individuals. But I think it's going to continue. As you can see there, the numbers really show that's going to potentially occur. So if you can see that there, this is the annual change in rental rates nationally, that graph on the right. You can see that pretty sharp uptick, 5.4%. So national rental index is up 5.4% over the last year to January. So it's a significant increase, and it'd be silly not to look at that. But from an owner's viewpoint, or from people who are looking to buy investment properties, that gives them some comfort in terms of increasing the income stream from that asset to offset any increase in borrowing costs or expenses. Yields, as I said, have been pretty steady, and this decline now to 3.56% is really because property values have continued to grow. So, it's sort of an inverse situation. So the yield is determined by the income and the gross value of the asset, and thereby the yield has decreased slightly. That's because the asset value has grown, and that's probably going to continue in over the course of this year. So, when we look at all of this data, I mean, how do we use the research and what do we do with it? Because if you have a look here, as I keep stressing, Australia is a very big place. So if you look at, Europe, UK, fitting into our landmass, it doesn't really touch the sides. And I can't stress that enough. And I think most of our long-term clients know that we look at this on a macro basis, and we look at, obviously, large infrastructure projects that change what's going to happen in certain markets, etc. But this is a pretty good thing to focus on. And the fact that there is no Aussie property market, people often ask me, especially from overseas, what's happening in the Aussie property market? And I go, well, firstly, let's try and temper that question. There is no such thing. It's many markets. So what do we look at? Well, again, we look at many things, but if you have a look at this, supply and demand also goes to what's available on the market, not just how many of a certain asset there are, how many of the owners of those properties are looking to trade those, to sell them. And if you have a look there, new listings, it's not a good sight, down 5.2% nationally, combined capitals down 3.2% and regionals 8.8%. So that's massive, and if you break that down the different areas, as you can see, new listings there, but total listings, it's even worse. Combined capitals are 18% lower than they were a year ago, and that means there are far fewer properties in the market. It's very, very tight, both from a rental and a sales perspective, and that's also putting pressure upward pressure on pricing. This is something that we did, data that we received after COVID, and it's very pertinent. People were looking for larger properties. If they were moving into medium density housing, they wanted, oversized apartments, either 2 or 3 bedrooms, and they wanted a multi-purpose room so they could have a home office to work from. All of those things still exist now, but you've also got the situation where there are more single person homes being formed nationally, and there's been a very strong increase in terms of one person households. So it's something we need to bear in mind, and a lot of these people tend to be perhaps baby boomers as well, and it's not that they can't afford it, but they can afford to have a more luxurious, larger space, and they just occupy it on their own. They may have family come and stay from time to time, but we've got to look at these buyer preferences, because I think a lot of them are here to stay, especially with work from home now being pretty much embedded into the Australian way of life, and most people looking to gain employment somewhere with an employer that will say, well, look, you do have flexibility to work from home, and it may be on a hybrid basis. So the other thing that we see is again, usually from people who perhaps have not entered the market yet. We've seen pretty amazing growth over the last 5 years in terms of housing values. Can that happen again? Will that continue, etc.? And clearly, if you look at what's happened there over 5 years, there has been great growth, but it's certainly not unprecedented, and that's what people forget, because most of these people that are looking to enter the market wouldn't have been in a position 10 years ago, probably age-wise, or 15 years ago, 20 years ago, to do so. So they're judging everything on the last 5 years. And as you can see, the rolling 5-year change in dwelling values, good Lord. And I do recall, the period around 87, then the other bounces where properties, especially in Sydney, increased really, really strongly. And as you can see there, the 5-year growth for dwelling values for capital cities has been very strong, but quite often people think that certain areas have outperformed others when they haven't. For example, Sydney, and then you look at Perth. But what you've got to look at, had a very sad time, after the mining boom. Property values declined for many, many years. So again, you've got to go back and look at all of these things in context, so you don't get the wrong idea and charge off and try and preempt what's going to happen over the next few years. I think it's far more important to be more grounded and look at what the data is actually telling you. So if you look at short and long term growth, as you can see, it's very different in different cities. This is really the growth that came after the rate cuts from last year, from 2025, and if that is the end of it, that was one of the shortest and shallowest rate cut cycles that we've experienced. We have some other data on what happens after the first rate rise in an interest rate rising cycle, but we're going to hold off on that and wait to see what happens over the next quarter, the next 90 days, to see whether this is a rising rate cycle or perhaps a recalibration in some of the decreases that the RBA brought through in 2025, to see how that pans out. So next quarter we'll show you the data on that. And at the end of the day, as we tell our clients, that investing in real estate is really as easy as pie, but that refers to population growth, infrastructure growth and employment growth, and those three macro tailwinds really mainly determine what's going to happen to a property market. Then of course it's asset choice. What type of dwelling are you going to buy, which ultimately leads to, if you like, your combined capital value growth and income growth over the course of time. So if we look at Sydney, Australia's probably best known city. New South Wales still has the most diversified economy, but really what we're seeing now is affordability starting to bite even further. The government's 5% first buyer home guarantee has been very successful. So home values under that 1.5 million for Sydney have continued to escalate more strongly than before. I think partly in relation to that government directive coming out. Affordability has always been a challenge for Sydney, but it seems that that's going to continue to grow, perhaps at a more relaxed pace during the course of 2026. And the other thing, of course, is that Sydney still is the recipient of the largest amount of overseas migration, but let's have a look at interstate migration further down the track, because that's really important too. So Sydney's change over the month, pretty flat, 0.2%, quarter the same, over the last year 6.4%. So a more relaxed level of value increase, and I think that's probably going to continue this year. If we look at Melbourne, Victoria's had many issues, a lot of them relating to the state's economy and indebtedness and what the state government has done there in relation to property taxes. Overseas migration has been strong, and they've always really done a good job in Melbourne in terms of promoting their tertiary learning institutions, so they get a lot of overseas students coming in there. Rental affordability is still one of the lowest of any of the capital cities in Australia, so I would say the best affordability, one of the lowest rental costs in any of those capitals around Australia. Quarterly price growth is picking up, and another thing we look at, the overseas students, again, another one of these politically sensitive topics that get thrown around the news all the time. Are they going to cap numbers? Are they not? I think you've got to again look at what's happening there, because as you can see over the month and the quarter, up 0.1% and 5.4% for the year. So really subdued growth as well, probably the lowest of the capitals. And then if you look at Perth, on the other side of the country, it's been an opposite situation. Annual city price growth is still very strong, but it's now slipped behind Brisbane and Darwin, interestingly enough. Still very high population growth, high rental growth, but affordability is also starting to become a bit of an issue for the Perth market. And that's really sort of crept in over the last 4 or 5 quarters, as we have seen these rapid increases in terms of property values. So if you look at the numbers here, up another 2% January, 7% over the quarter, 18.5% over the last year. So if you compare that to Sydney or Melbourne, over 3 times as much. So if you have a look at, this is at the 31st of December, just passed, you look at those median values, and Sydney at nearly 1.3 million. Well, Brisbane's the next on the ladder at just over 1 million. So this is interesting, and we have a lot of clients, particularly Australian expat clients, sort of speaking about, where is Brisbane? Melbourne's where most of the corporate headquarters are. It's fastest growing city, etc. Well, as we've said over the time, I think it's really important to look at data rather than just what your own thought process may be, and that has certainly played out over the last 5 to 10 years, I suppose, and people need to bear that in mind, because Sydney, Brisbane, Melbourne are the sort of largest, more stable economically and politically capital city markets in Australia. So it's worth looking at that. Places like Darwin clearly can be far more volatile, and Perth too for that matter, because their economies are exposed to certain sectors, so their state economy or territory economies are not as diverse, and we need to look at how that plays out, not next year or the next year or two, but over the next 5, 10, 20 years. So we can delve into that in far greater detail, especially if someone needs information on a one-on-one basis. The other question we get all the time is, should I buy a new property or an old one? And as I've told people forever, there's no right answer to that. It really depends a lot on your own situation, what you're looking for, your current portfolio, your goals with that asset. But being realistic, if you're going to buy an old property and want to add value to that through redevelopment or renovation, it's probably helpful if you had some experience in the construction industry. You're closer to retirement, where you might have more time, or you're seeking a project to keep you occupied. It's pretty hard, I think, these days to compete with professional developers, especially because to obtain trades in Australia is really difficult, and I'll come to that, but the government's taking so many of those tradespeople out of the economy, and they're going into building large government infrastructure projects. So home builders don't have access to that, and if you're an individual, you're going to be paying a lot more and find it more difficult to obtain that sort of skilled labour than if you're a full-time employer. For our clients, who, as I say, generally demographically are very time poor, high income earners, new property seems to be certainly more exciting for them, and in many ways also more beneficial from a tax viewpoint. They want that light touch scenario. New properties tend to be rented more easily, have better tenants, they stay longer. In Australia, they give you extra benefits, tax benefits. They're easier to manage. So people like that, but then this is really important, especially these days. When we look at how heavily we are taxed in Australia, those non-cash benefits in terms of deductions, Division 40 and Division 43, are terrific. So you can deduct 2.5% of the build cost of a new property over the next 40 years against your personal exertion income or other income, and the Division 40, the fixtures and fittings, are usually sort of obtained through obtaining a quantity surveyor's report and also written off against your other income. So pretty effective. And it shields a lot of clients. As I say, a lot of our clients are obviously paying the top marginal tax rate, and that's an issue. So if you can get some amelioration of that, then it's something that most people obviously enjoy and seek to get the maximum benefit from. So what does all the data tell us? The same thing it's been telling us for quite some time, actually. in terms of which region requires us to focus on, and that's been southeast Queensland. There's still a very substantial value gap to Sydney. As I said, it's certainly picked up ground, now being the second most valuable capital city market in the country. But I think a lot of that's been based on some really strong macro tailwinds. Interstate migration is still at levels highest in 15, 20 years. We look at the MB.BS statistics every quarter, continues to show that, and the outflows from Sydney. So, while Sydney gets the largest net overseas migration, that outflow going to Queensland from New South Wales, mainly Sydney, I think is again, that affordability situation. So people can sell their home in Sydney, go and buy something in Brisbane at a much cheaper level for an equivalent asset, and enjoy the lifestyle there, get generally a similar income and pay less for costs such as private schooling for their kids, etc. So that's really, I think, an important factor. The work from home situation has been another big tailwind, I think, for that region of the country. The state has a well-diversified economy, and so that's going to continue to grow. But now we also have the Olympics coming up, so that's another major tailwind. I'll come to that in a second. But if you have a look at the numbers, for Brisbane, up 1.6% for the month, 5.1% for the quarter, and 15.7% for the last year. So here we go. Let's have a look at these numbers, because that's what I've been speaking about. It's really important. So overseas arrivals, departures, so net overseas migration, that top table there. New South Wales, as you can see, the highest, second highest Victoria, Queensland, then WA, South Australia, and tiny numbers for Tasmania, Northern Territory and the ACT. But if you have a look at interstate arrivals and departures, New South Wales has got by far the highest, over 24,000 people leaving. Victoria, slight negative, and Queensland getting that influx, nearly, over 21,500 people coming in, 10,000 in WA. So those are the people that are generally going to buy something rather than rent, because, to move your family from one state to the next, you've generally already obtained new employment, you've looked at schooling for your children if you have those, you've done all of those things, so you're going to buy something. So important to differentiate renters from purchasers. If you look at that on a graphical basis, it shows you pretty clearly that Queensland is the beneficiary of the outflow from Sydney, if you bring it down to a capital city level. So that's been continuing to be ongoing. These are the levels, the latest ABS figures to June last year. That population growth of 2034 that was predicated by the Department for Population Growth is continuing to continue the way they thought it would, and if anything, I think those numbers are now starting to increase further. Then if you have a look at things, within markets, and we do that, this is for Brisbane, and if you look at the number of new dwellings that need to be supplied, so apartments, for a balanced market, within 5 kilometres of the CBD, it's 7,500 per annum. And that hasn't happened since 2018. And if we have a look at what has been happening over the more recent years, since then, the last 9 years, we can see that undersupply is something that's really structural and continuing. So it's going to continue to put pressure, as we've seen, on housing prices, particularly the higher quality end of things, because that's where the baby boomers who are selling their homes are looking to purchase something that gives them those qualities they look for: greater security, amenity, etc. And I think that's going to continue in that market for many years to come, because it's very hard to turn that around and suddenly produce all these dwellings when you can't get the tradespeople to do it, and costs continue to rise as they have been. So if we look at the Olympics, it's I think it is a large macro tailwind, and it's now starting to get to the real situation. It's going to be in 2032, So another 6 years away, and it's going to be significant in terms of the infrastructure that's already being provided, further infrastructure that's yet to be started, the population growth that's driving, the employment growth that's driving, and many of these things, which are multi-billion-dollar projects, are nearing completion or halfway through or have been commenced. So let's have a look at this video in relation to that, and I think everyone should listen to this because it gives people a pretty good understanding of what's actually occurring in Brisbane, on the Gold Coast and Sunshine Coast, that whole triangle out to Toowoomba, where this infrastructure is being built.
This Games was never going to be like other games. It'll be a Queensland Games. We can't just build for a few weeks of competition. We've got to build for the decades to come. We need a plan, and it's time to deliver.
The only thing bigger than the Olympic and Paralympic Games is the opportunity to connect Queensland by building the roads and infrastructure we're going to need for decades to come, all while we drive tourism and back our grassroots clubs. And now the new Queensland government has set the plan to deliver it. To keep our growing population moving now and beyond 2032, Queensland needs a better connected and accessible transport network. For Brisbane, there'll be new rail lines and stations, with new northern and eastern bus priority corridors, and road upgrades will get people around a growing city. There'll also be an exciting new sports and entertainment precinct in the heart of Brisbane, where Victoria Park will become home to Brisbane Stadium, designed to attract world-class events. The Centenary Pool will be transformed to become our national aquatic centre, with more than 25,000 seats and multiple pools, ready to host international competitions and train the next generation of champions. New life will be breathed into the RNA Showgrounds, as well as housing the Brisbane Athlete Village. An upgraded 20,000-seat arena will host key events and give the Queensland Ekka an even brighter future. A major upgrade of the Queensland Tennis Centre will include a new 3,000-seat show court arena and 12 new match courts, which, in addition to Pat Rafter Arena, will bring even more tournaments to Brisbane. Across the city, existing venues will come alive. Plus, there'll be new and accessible indoor sports centres at Logan and Moreton Bay, and a new whitewater rafting centre in the Redlands. From Brisbane to the Gold Coast, faster rail with new stations will reduce commute times, while future upgrades to the Coomera Connector and M1 will connect growing cities. The Gold Coast will be home to an athlete village and host events at a new arena, an upgraded hockey centre and convention centre, while hosting the triathlon will showcase our golden beaches. In Toowoomba, the famous showgrounds will be transformed into an equestrian centre of excellence. To the Sunshine Coast, Queenslanders will ride the wave, a new direct rail line linking with a state-of-the-art metro hub that will connect to the Sunshine Coast Airport through Maroochydore. The CBD will be transformed with a new integrated athlete village, arena and cultural precinct. These Queensland Games will reach beyond Brisbane, delivering generational infrastructure for the whole state, including a better Bruce Highway connecting the regions and the rest of Queensland. This plan delivers legacy beyond the Games with the largest investment in infrastructure in Queensland history. Athlete villages will become homes for thousands of Queenslanders. The private sector will be engaged to turn the Gabba into an entertainment precinct with new housing, giving Queenslanders even more ways to enjoy Brisbane and providing access to bigger and better sports and entertainment. A Games we can all be proud of, and a legacy that will live on for generations of Queenslanders for decades to come.
Sounds like a plan to me. Let the Games begin.
So, I think that sort of speaks for itself and gives people an idea of the sheer magnitude of the Olympic Games infrastructure projects that are occurring at the moment, and what that's going to do for that area of southeast Queensland. So what's the value proposition in terms of all of this? We're trying to help our clients and people listening to this to help them buy into a strong market of the future, because people, it's like the sheep situation, the herding. people buy into something when it's at a peak instead of looking at what's going to happen over the years to come. There is no lack of information or research available these days, so it's more a question of how do you distinguish the signal from the noise, and I think that's really difficult. And I think decades of experience certainly go a long way to helping us do that, and thereby we pass that on to our clients. Ignoring your point of difference, where people quite often say, look, I've been waiting for so long to buy something, I just want something. You can't afford to ignore your point of difference, because that's going to make the difference in the future to you and your asset growth. And then of course, the reverse side of that, you keep looking at information and research for years and years and years, and you don't do anything. And we've had this often, where people say, oh gosh, I wish I did this 5 years ago. And you ask the question, why didn't you? And quite often it is that lack of ability to say, I'm going to do something, because you see a whole lot of conflicting research or information. You don't know how to sort the right from the wrong. And then, as I always say to people, make sure you try and find some unique attributes to the asset you're going to purchase. So any investment will not actually do. If you have a look at single economy markets, Port Hedland's a good example, iron ore, but also areas that have a lot of low quality investor stock, which was marketed over years gone by, especially to the Asian investor, small inferior quality apartments with compromised floor plates and hundreds of the same thing in the same buildings or the same area. They're not going to help you. It doesn't matter if that's in Docklands or inner Melbourne somewhere or Surfers Paradise. Any market that shows that is going to be inferior, and we tell clients to generally look elsewhere. So, let's put it all together. Strong economic activity, infrastructure growth, employment growth, future sustainability of that, and certainly the unique attributes of the property you're going to buy. And that's what we try and help people do. And they usually end up with a great outcome. So, what are the opportunities past last year, now that we've changed all of this, 2026 and the decade beyond? Well, what we do is we tend to look at properties before and after and during, so that we make sure that people get what they see, I suppose.
Royal Brisbane Hospital, and you have a lot of amenity around this area in terms of transport, in terms of restaurants, bars, places you can go to in Fortitude Valley, which are clearly not far removed. And it's interesting to note that the skyline here reflects some of the urban development that's happening in the sort of inner middle ring of the Brisbane region. We always like to have a look at construction before and during and after, when sites are getting built, to give us a far better understanding of what our clients are going to see when they receive their finished product.
So that's a before and after situation. We've shown our clients these sort of things, dozens of times over, and it's really important and gives people the confidence to say, well, I like the look of that, but also know that that's what they're going to receive at the end of the construction period. So this is something that's very recent, again, unique position, actually on the sand, so genuine beachfront. Not with a road or trees in front of it. And if you have a look at this in terms of unique attributes, I mean, how can you find absolute beachfront property in Australia these days? It's very, very difficult. So, people say, what's unique? Well, these sort of things are, and of course, that's a certain location, but it's amazing to actually come up with things like this if you sort of get enough time and work to research and find these opportunities for people, rather than just going. It's really a gratifying process, and then a gratifying experience when our clients end up taking delivery of something like this and getting the feedback from them. So really importantly, if you look at finances and how you pay for things, who pays for your property? And this is sort of a typical year one scenario for an Australian resident domestic client. Tenant pays for the majority of it. The tax office pays for the large chunk, and you pay for a very small one, 6% in this instance. But that varies obviously if you're a resident or non-resident from a cash flow viewpoint, if not from an integral viewpoint, because some of the tax credits that you receive you can use against Australian taxable income. So if you're an Australian expat living overseas, you may not be able to utilise those in their entirety up front. You'll have to save the rest of those credits for when you either A, expand your property portfolio to make further incremental increases in your income, or you go and sell it, or you move back to Australia and start earning personal exertion income in Australia again. That certainly helps cushion the blow for many, many of our clients who are expats currently and then move back to Australia. So we look at a property investment analysis. We look at the costs of acquisition, the ongoing costs of ownership, and then try and quantify those so that people have an idea in terms of what that could look like on current assumptions. And it's important to recognise that and look at the long-term, history of things. Rents tend to increase over the long term by at least the value of the Consumer Price Index, or CPI. So keep things, I think, conservative is the best way to look at these situations. And as you can see, the cost for someone who can't use all the tax credits initially is going to be far higher than someone who can. Same scenario, same asset, same assumptions, but different cash flow outcome. Not a different outcome in terms of the overall cost. So, as I said, in this instance, as a non-resident, you have to wait until potentially you repatriate to Australia or sell that asset to utilise those tax credits in their entirety. Something I like to finish with, because people often get the two things confused. Investment and speculation, and property is a long-term investment vehicle, really. So it's something that's a higher price item, quite often with leverage attached. It's not divisible, so unlike, say, a basket of shares that you can sell a small portion of at any given time, you can't sell small portions of a property. And the numbers, though, are really, I think, helpful for people to understand and become an investor and look at this over the long term, because as I often say to people, look, buy a great asset, you don't really need to do much else, just keep it. And as you can see over the passage of time, as you go through that period of, say, 18, 20 years plus, the value of that asset really continues to compound and increase. Most people tend to sell things sort of, between year 2 and year 8, I suppose. And quite often, I've seen this happen where markets take off, someone goes, I just got an offer that was too good to refuse. And then you see them 5 years down the track and they go, oh my God, I wish I kept that. So really important to try and help yourself define investment versus speculation, because quite often, you don't have to spin the wheels the whole time to get the best outcome. Property is certainly one of those assets that has the attributes to give you great investments if you make great choices in the first instance. So, what's the Wise Guru difference? We've had over 3 decades of experience. As I said, we can get specialised loans that give people an increased lending capacity and not pay, say, lender's mortgage insurance. We can help people look at ways of structuring their assets so that they maximise their tax position, and try and find, as I say, assets, properties with unique attributes that really appeal to segments of the market that are exhibiting good, sustained long-term growth, and we think will continue to do so over time. So if anyone needs help with their own personal situation, please don't hesitate to reach out, email us, call us, and we'll have somebody contact you and gather the information required so that we can, then have a more informed discussion and see how we could help you potentially with your own situation. In the meantime, have a look at what your position is. If you want any general information or specific personal advice, just get in touch with us.